BEPS Pillar 1. Amount A and Amount B. That's what we are going to discuss today in this video. First, we advise you to watch our previous video, which provides a quick overview of the global minimum tax, as it would be really helpful to understand this one. Hello everyone, and welcome to the Tax Gate. Hit the subscribe button and let's get started. As we highlighted previously, that global minimum taxation rules fall under the umbrella of BEPS project. And BEPS project is an initiative of both G20 countries and the Organization of Economic Cooperation and Development (OECD) to amend international tax laws which had not been changed long time ago. Well, also, as explained, that BEPS initiatives has mainly two phases till date, and BEPS Phase 1 led to BEPS second phase, which focuses on the tax challenges arising from digital economy, and that's why both OECD and G20 came together with an updated statement for an agreement including two pillars solution to address and tackle the tax challenges arising from the digital economy. And today let's dive a bit deeper into Pillar 1, which provides profit allocation model where the profits will be reallocated to the market jurisdictions regardless of any physical presence in those jurisdictions. Also, it will apply on multinational enterprises with total profitability above 10% and global turnover or a worldwide revenue of initially above 20 billion euros, trying to ensure that multinational enterprises pay a fair share of tax wherever they operate. Good. So talking about Pillar 1, then we should highlight that it would include mainly two elements: Amount A and Amount B. So let's start with Amount A. And here we would say that Amount A was created to allow jurisdictions to tax the income of foreign multinationals even if there is no taxable presence in that jurisdiction. And such would apply on multinational enterprises that have global revenues that annually exceed 20 billion euros and profit before tax to revenue ratio exceeding 10%. Well, so Amount A aims to reallocate a portion of the profits of the large multinationals to the jurisdictions where they operate in, and sourced revenue from as well, to be subject to tax in that jurisdiction. To put it in a different way, Amount A is the amount of taxing rights to be reallocated after being calculated from global residual profits of the multinational enterprises. And here global residual profit would be defined as all the profits above the 10% profitability threshold. Well, so following this quick introduction, let's now move to Amount A, rules and process, which would mainly include the following items. Revenue sourcing. In order for a jurisdiction to have the right to tax the income of a foreign company, then such income needs to be sourced and connected with that jurisdiction. So, Amount A profits would be reallocated to a market jurisdictions, based on the share of revenue sourced from those jurisdictions. And here we should highlight that a specific indicators would be in place to be considered as basis to source such revenues. And also each type of revenue would have its own sourcing rules as well. Good, let's move to the next point, which is adjusted profits calculation. Once it is confirmed that revenue is sourced to a jurisdiction and it is above the needed threshold, then the multinational enterprise would then need to calculate its adjusted profits before tax. And once the adjusted profits are calculated, then Amount A allocates a proportion of the mentioned adjusted profits to the market jurisdictions. Good. The next point would be profit reallocation calculation. And here we would highlight that once the adjusted profits are determined, then the multinational group would prompt with the profit reallocation calculation according to the profit allocation rules, which should determine the amount of profit that is going to be allocated to the market jurisdictions, and here such amount is 25% of the profits that will be above the 10% profitability threshold. Well, so once those profits are determined, then they will be allocated to the jurisdictions based on the proportion of local revenue sourced from those jurisdictions to total group revenue. And here it should be highlighted that the profits that are going to be reallocated to a jurisdiction will be then subject to tax based on the corporate income tax regime of that jurisdiction. Good. Next point is marketing and distribution profits safe harbor calculation. Well, to put it in a very straightforward way, this rule works as a capping mechanism on the allocations of the calculated amount A. So, it is a rule designed to address the issues related to double counting in case we have a market country that has the ability to tax residual profits of a multinational enterprise in two ways. 1. Under existing profit allocation rules, which would be, for instance, the transfer pricing rules. And the second one, through amount A allocation. So to avoid this to take place, additional step is included in the calculation of amount A to reduce the profits reallocated to that country by the amount of the profit already taxed there. Now with the last item here, which is the elimination of double taxation. So, as amount A came on top of already existing profits allocation rules, and the profit of an multinational enterprises would be already allocated under an existing profit allocation rules. Then a mechanism to reconcile the new taxing rights and the existing profit allocation rules should be necessarily established to avoid double taxation, and that's the job of this rule. Good. With this, now we can move to the next element of Pillar 1, which is amount B. And here the purpose of this model is to simplify transfer pricing rules for both tax authorities and multinational groups as well. The intention is to standardize and streamline the pricing of baseline marketing and distribution activities in a way that is aligned with the arm's length principle to reduce disputes in this area, which commonly trigger disagreements between both taxpayers and tax authorities. And here baseline marketing and distribution activities under amount B would have a broad concept that would include marketing, sales, and logistics functions as well. Finally, we should highlight that OECD framework has developed and still developing the framework for amount B to set out the scoping criteria, pricing methodology, documentation, and the tax certainty considerations. Good. It was still a high-level explanation covering Pillar 1 under BEPS initiative, so like and subscribe if you would like to understand more tax topics covering the newly implemented global minimum taxation rules, and thanks for watching TaxGate.